All right, today we are diving deep into an absolute giant in the industrial gas world, Air Liquide. We're going to unpack the full investment case here, breaking down the analysis to see exactly what makes this company tick from an investor's point of view. Let's get right into it.
So, here's the big question we're kicking off with. Could there be this massive, unrecognized opportunity hiding in plain sight? I mean, this company is a behemoth in its industry, but for a lot of investors, there's been this one persistent puzzle.
And this table, this right here, is the heart of that puzzle. You see Air Liquide, a €100 billion company, but then you look at its main rival, Linde, and you see it trades at a huge discount. Just look at those margins and the forward PE ratios. Linde has just been more profitable, and because of that, the market has given it a much richer valuation. So for any investor, the question is simple. Is that gap fair? And more importantly, can Air Liquide actually close it? To even begin to answer that, you have to understand the bedrock of this company. So before we get into growth, let's talk about stability. People often describe Air Liquide's business as a fortress, and honestly, it's for a really good reason. This right here shows you how they build the walls of that fortress. It's all about diversification. Their income is spread out across so many different sectors. You've got large industries providing this super stable base, then the huge industrial merchant segment gives them pricing power. Healthcare, well, that's almost totally disconnected from the ups and downs of the economy. And then you've got the high-tech electronics business just riding that massive semiconductor wave. It's this powerful, self-balancing portfolio that can weather almost any storm. And holding all of that together is something the analysis calls a contractual moat. And, this isn't just some clever metaphor. It's a real, carefully designed system that basically engineers predictability right into the core of their business.
And this moat has 3 key layers of protection. First, the contracts are insanely long. We're talking 15 to 20 years. That gives them incredible visibility into future revenues. Second, they have these take-or-pay clauses, which are a massive shield in a downturn. It means customers have to pay for a minimum amount of gas, whether they use it or not. And finally, the real kicker, price indexation. Any rising costs, like energy, get passed on automatically to the customer. You put all that together, and a huge slice of their revenue starts to look less like a business and more like a predictable, bond-like annuity.
Okay, so we've established it's a stable fortress. That's great, but stability alone doesn't close that valuation gap we saw, right? For that, you need a catalyst. And for Air Liquide, that catalyst has a name: Advance. It's their strategic plan, and it is laser-focused on one thing: jacking up profitability.
And here's the scorecard. What's so compelling here, especially if you're an investor, isn't just that they have a plan, it's that they are executing it flawlessly. I mean, they're not just meeting their goals, they're absolutely crushing them. Sales growth? Done. Return on capital? Exceeded. But the real headline here is the operating margin.
So get a load of this number. The company's first goal for margin improvement was 160 basis points. That's 1.6%. Well, they blew past it so fast they had to raise the target. And then they raised it again to this new, frankly, unprecedented target of a 460 basis point improvement by 2026. That's a 4.6% improvement.
And this quote from the analysis just says it all, doesn't it? This isn't just a good quarter or a temporary fluke. You just don't raise a key strategic target like this twice unless you are absolutely convinced that the improvements are structural, they're sustainable, and that your performance is running way ahead of even your own best-case scenarios. This is their direct assault on that profitability gap with Linde.
But improving the core business is only one part of the story. On top of all that operational excellence, Air Liquide is layering on a massive, multi-decade growth opportunity. We're talking about the energy transition, and they are making a huge bet on hydrogen.
And believe me, this is not just lip service. They are putting their money where their mouth is. A full half of their massive €16 billion investment plan is going straight into decarbonization projects. This is a fundamental strategic pivot for the entire company. And drilling down into that, their commitment to hydrogen is just enormous. They're planning to pour around €8 billion into the low-carbon hydrogen value chain by 2035. To put that in perspective, that's nearly 8% of their entire company value today, on this one technology. And of course, the goal is to turn all that investment into serious revenue. They're aiming to at least triple their hydrogen business to over €6 billion in turnover by 2035. They want to turn this future tech into a major profit center. And to make that happen, they're building out the actual physical infrastructure. They're targeting 3 gigawatts of electrolysis capacity by 2030. That is the core technology you need to produce green hydrogen at a true industrial scale.
Now, what's so crucial here is that this isn't some speculative hope-for-the-best gamble. They are systematically de-risking this massive bet. How? By using their classic playbook, signing long-term contracts with industrial giants before they build, creating these super-efficient local hubs, and even controlling the core electrolyzer tech through a joint venture with Siemens. It's a disciplined industrial strategy, not a wild tech bet.
So, we've got the stable fortress, we've got the profit-boosting catalyst, and we've got the long-term megatrend. So how does the analysis tie all of this together for an investor? What's the final verdict?
Well, the final take is pretty balanced. The bull case is crystal clear. They are executing a plan that is actively closing that profitability gap. They're a leader in the massive hydrogen megatrend, and that all creates a very clear path for the stock's valuation to climb higher. On the flip side, the bear case is that, hey, the stock isn't exactly cheap compared to its own history. Spending this much money always carries some risk, and their main competitor is still incredibly strong.
But after weighing all that evidence, the report's conclusion is direct. It's unambiguous. It's a buy recommendation for long-term investors. The core idea is that the market just isn't giving them enough credit for how well they're executing this plan.
And really, that leaves us with the final question, the one you have to ask yourself. You've got this fortress-like business, a powerful catalyst in the advanced plan, and this huge growth runway with hydrogen. But is that potent combination, a proven plan and truly stellar execution, is it really enough to finally close a valuation gap that's been there for years? That is the multi-billion euro question.